Dr. Joe Lai, welcome to the Equities and Growth Assets Symposium.
Thanks, Peter.
Can you tell us a little bit about the opportunity set for your emerging market strategy?
Okay, thanks. So what we try to do is to bring the best ideas into the portfolio to capture the exciting opportunities arising out of predominantly Asia and also emerging markets. So Asia is a big part of the world. There's lots of interesting companies. What we're interested in are the companies which has long growth trajectory, good quality management and businesses, and the valuation is cheap. So the opportunity set is basically all the companies in this region with all these characteristics.
Could you sum up your basic approach to investing?
Okay, so we believe that some of the market sometimes can be inefficient, but most of the time it is efficient. When in times of inefficiency, valuations of even the great companies in the region can come down a lot, and we as investors have to take those opportunities to actually buy those businesses when they're cheap, and to do that, we have to be very disciplined and need to have very independent thinking. I've got some ways, to actually help our team to implement the discipline required to follow this process. It's actually quite simple. 3 steps. The first step is to look for industries with long-term secular growth trend when it's underappreciated. The second step is to find the best companies that can be leveraged to these trends. And the third step is, this one is very simple, but it's easier said than done. Do not pay up. Now, seasoned investors may ask me, well, how do we find good companies with great industry dynamics and trading at a cheap valuation? So the answer is to think different and be able to understand the nuances and the context of the industries and the companies involved. At Ox, we have this culture of transparency, psychological safety, and analytical honesty. That keeps us honest in terms of understanding what's going on and actually decide, when the market is too extreme in its sentiment up or down.
What about the benefits of allocating to Chinese stocks and other EM stocks in portfolios that are generally US dominant?
Yeah, that's a good question. So a few points. The first is just there's lots of growth in this region, China and other parts of emerging markets. It's underinvested by most investors, which actually makes them prospective. And the third is this. Some of these emerging countries actually would do quite well in a reasonably high inflationary environment, which is different to that of developed markets. Maybe I'll go into this in a little bit more detail. So if we look at emerging countries, it's actually making up the majority of growth in the world. It's actually more than half of the world's economic output these days. But if we look at the representation of emerging markets in MSCI global or MSCI indices, it's literally just in the teens. It really shows you a significant underallocation to the market. So that's the underallocation bit. As a result, the valuations of emerging country stocks are very cheap. Literally, the same similar companies in the same industry, but with the faster growth dynamics, will be trading at 50 to 70% discount to that of developed markets. So that is a good starting point. And the last thing I mentioned was inflation. So some countries in emerging markets are actually resource exporters. So in an environment of heightened inflation, and I believe over the medium to even long term actually going forward, these countries will actually benefit from higher raw material prices as opposed to consumers getting sapped, getting taxed on their spending. So we think that it's actually highly prospective at this point in time, with growth, with undervaluation, under allocation, and also some of them will do well in the current environment that we're in.
What are some of the nuances in investing in China at the current time?
Okay. Yeah, look, China has been tricky in the last 12 to 18 months. I've been investing in China for about 18 years, along with other parts of Asia, actually, and reasonably successfully, I would say. So it requires experience, and it requires the understanding of the nuances of what's going on the ground. So as I mentioned, I've got some experience investing in that market, and we've got actually a person in our team stationed in Hong Kong and China, from roughly half of the year, out of the whole year. So we've got the nuance and the experience. But the key thing I guess, a few pointers is just that there's a few things people have to pay attention to. And the first one is geopolitics. I mean, the reality is the world's changing, and then some companies, although looking good at the moment in China, may be quite prone to some of the geopolitical threats coming from outside. So it's one, and we try to avoid those because it's so hard to know exactly what's going to happen to that. For example, access to certain technologies. The second point is just the volatility of the regulatory cycle in China. People talk about crackdowns and when the government comes in, what do you do? Valuation comes off. But over the years of investing in China, there's been numerous crackdowns in Chinese companies. Another word for crackdown is actual reform. So because the economy is growing so fast, they have had to actually reform or crack down on industries when they become dysfunctional. However, the recognition of when crackdown is going to come and what do you do at the end of the crackdown is important, because the reality is this: after the industry has been cracked down on, the rules of engagement actually improves out of sight. And the leaders of those industries can actually do well for many years, and you can get them at very cheap valuations. And then lastly, it's just the monetary or stimulus cycle. It can go on and off. At the moment, it has been tightened for the last almost 2 years now. But at the moment, what we're seeing is actually sort of a peaking of the regulatory tightening, the peaking of the stimulus cycle, as in troughing of stimulus cycle, I meant. And so it's actually, the valuation is extremely cheap. We're very selective in China to buy the best companies that can actually have this long-term growth trajectory, which I mentioned before in our process.
Where do you see the greatest opportunities in the world today in terms of both sector and geography?
Okay, that's a good question, because what we believe that we are going into the world of high inflation over the medium to long term for a few reasons. So we preferred countries which will benefit from higher prices, from high inflation, than those which suffers. So the key one country we like is Indonesia. So Indonesia is a populous country, almost 300 million people. People in Australia, probably quite familiar with some of the places in Indonesia because of travels. So what it is a country which exports energy and commodities, and it's actually been benefiting in terms of trade, export revenues coming in, that country. Over the last 10 years, the country also has undertaken quite a large number of structural economic reforms, which will benefit the country when it takes off again. And thirdly, the country is emerging from the COVID lockdown over the last 1 or 2 years, like many parts of the world. So all these things, taken together, it's actually leading to a significant economic revival for the country. We're seeing consumer, spending picking up significantly since, I guess, end of last year, and it's continuing on this year. And also business investments also coming through. It's likely that it will go through a capital expenditure cycle in the next, this year and the next few years. So we like the long-term story of Indonesia, and there's a lot of companies of different sectors within that country that we have position in, and we like. They are on very, very cheap valuation because people have sort of stayed away from Indonesia over the last 10 years because commodity prices hasn't been good. Companies growing at literally 20, 30, 40%, and we could get some of them on a T&P multiple. So that's quite exciting.
Finally, your 2 highest conviction ideas.
So I'll continue on the theme of Indonesia. So one of our most ideas of the highest conviction is this company called MAPI. It's an Indonesian distribution partner for global brands. So as you can appreciate, Indonesia is difficult to access because of the islands in the country, and also there may be some red tape which needs help smooth over. So what this company does is it actually forms distribution partnerships with global brands to actually sell to the Indonesian consumers. Some brands, like for example, it's 150 brands literally. The brands include Calvin Klein, Adidas, Nike, what have you, Zara. It's just countless. Whatever you can think of, most likely it's its partner. So it's effectively a toll road to the Indonesian consumer. We're collecting a clip every time anyone spends money on these brands. online and offline. So it's fantastic. And of course, it's benefiting from the consumption revival of Indonesia, we mentioned just then. It's benefiting from the COVID opening up that's happening at the moment. And, the stock is likely, or the company's earnings is likely to grow at a pace of like 40% over a year, over the next 2-3 years. And it's on about 15 times PE multiple. It really tells you the story, really follows our process of, good long-term growth, underappreciated, strong company, and also cheap valuation. So that's one. Another one would be, I would talk about a Chinese company because we did allude to the Chinese market. So we are selective in China. We're just not just buying, thing that everyone likes. So the story of this one is the company is called AK Medical. So this is a leader in orthopedic joint implants in China. As you know, China is a huge country and people are getting wealthier and there's a huge demand for this kind of stuff. And at the moment it's underutilized or underpenetrated in terms of implants or generally speaking healthcare. So growth is just going to be huge. But the problem is this, over the last decade or 2 decades, there's been a lot of dysfunctionality in that market. So people who can perhaps provide the right incentives can actually get their products sold to the hospitals and therefore make the money, and the prices are very high. So in the last 2 years, the authorities in China actually came down and actually cracked down on these behaviors. So a lot of these dysfunctionalities have disappeared. And what's left, though, is interesting, right? After crackdown, who's going to be the winner? So instead of the distortions, which favors companies which spend money on marketing or sales or incentives, it actually favors companies which actually have the best product at a good price. So AK Medical has strong R&D. It also has acquired a number of foreign hip and knee joint companies in years gone by. It's a leader in 3D printing of joints for the more bespoke application of the transplants in China. It's by far the leading joint company, local joint company in China. The quality of the products is similar to that of imported products, but they're selling it at a big discount, 30% discount to the imported products. So this company is set to win in the next 5-10 years going forward. The regulatory crackdown did lead to a 1-year reset in sales and profits, but we think that this company can grow by 30-40% again, and it's on about 20 times PE multiple, 30-40% a year in the next few years. So that's rather exciting. When there's a lot of worry and negativity, we try to take a step back and look at the long-term trajectory, how good the company is, and the valuation. And so that's how the process works. That's how we can identify the weaknesses, the opportunities in the markets.
Dr. Zhou, thank you very much.
Thanks very much, Peter.